Welcome to the Innovation Factory, to episode 3. My name is Prit Banerjee. I am CTO at Ansys. In this channel, we are talking about the general topic of innovation. And in the first episode, I kind of talked to you about innovation in larger companies and the whole concept of Horizon 1, 2, and 3 innovation. Episode 2 focused on innovation in academia. And today I'm going to talk about innovation, how it happens in startups. So let's begin. So today, what I'm going to talk about is how innovation happens in startups, provide a very brief personal background about how I've done a few startups in my career, and then share some insights by interviewing Amit Narayan, right, who's the CEO of AutoGrade, and he's provided some fantastic insights that are actually in my book, in chapter 3 of my book on Innovation Factory. And then I will talk about who are the people who actually founds these startups, right? There's these entrepreneurs that come from academia and from larger companies or from other startups. And then the success criteria of startups. Right? If you are thinking of starting your company, right, what are the criteria that people are looking at, right? And then we'll give a very simple example of how to create a business plan for a startup, and then talking about sort of the different funding levels. How do you raise Series A, Series B, Series C fundraising, and then ultimately how can you form partnerships with startups? So so I just wanted to provide a background on innovation in startups. Right, in the first two episodes, I talked about the general concept of innovation, three horizons of innovation: Horizon One, the short term; Horizon Two, which is the medium term; and the increment; and Horizon Three is the truly disruptive. And today, I'm going to talk about the fact that startups are really focused on this Horizon Three, the disruptive innovation, because what they do is they identify a niche market and they build a very, very focused product for that market. And then they take that product and they come up with a sales and marketing strategy tailored to that product. And essentially, startups are just much more successful than large companies in developing disruptive long-term innovation. So let me kind of define for you this whole difference between long-term innovation and disruptive innovation, right? Large companies, right? I mean, they are absolutely they do this long-term innovation very well, but it's a series of incremental innovations that they do, right? So essentially, it's very well planned, stage innovation, stage gates, and so on. And I used to work at large companies in the past, and I've seen this work very well, right? So you have an existing product, and you're just making progress on that product with a long-term view, right? For example, you're a toy manufacturer, and like Mattel, right? And you may introduce a movie character like maybe a Mickey Mouse, right? And so it just the first version is just a plastic statue, right? One blob of a mouse, right? With the kids really enjoy playing and so on. And then you have the future innovation that will add some moving arms and legs to the mouse. Then a future one will have a motor for the motion of the arms and legs. And then you have a voice feature where the mouse actually talks to you, right? So there are minor changes that you're making, series of steps in that innovation process, and that's how innovation happens. So you look at a large car company, right? You have an original car, and then you add power steering to the car, then you have power windows to the car, and so on. And that's how long-term innovation happens in large companies. Now, in contrast, the disruptive innovation is this completely disruptive ideas, right? And which is best done with startups, right? So some examples of disruptive innovation are, for example, the handheld calculator, right, from HP, or the World Wide Web that came out also with the Mosaic browser at the University of Illinois, or smartphones or smart tablets, right? Things that came out, the iPhones and iPads, right? Or the apps that run on these phones and tablets, right? And cloud computing, sort of computing as a service, storage as a service. So these are examples of disruptions that, again, at that time, the right sort of startups were involved in these technologies. So let me kind of share with you some brief personal background. As I mentioned in episode one, I've been fortunate to have sort of three phases in my career where I was first 20 years in academia, then I did two startups, then I worked in some larger companies, right? So today I'm going to focus on the experience in the startups. I did two startups in my career. The first one was ExcelChip, which I founded in 2000, and essentially based on technology from Northwestern University, where I was a professor. And for that, I was able to raise a little more than 2 million in Series A, 5 million Series B from investors such as Arch Ventures and Interwest and Greylock and so on. And using that funding, we grew the company to about 25 employees, 5 million in annual funding, and essentially was able to sell the company to Xilinx Corporation, right, for 25 million. So it was a very good personal experience of how you take an innovation from a research lab in universities and go all the way. Did a second startup, Bionochip, right? A similar thing, right? Starting from the University of Illinois, Chicago, raised funding, and then sold the company to Quickstream Media. Now, in addition to those startups that I personally was involved with, right, I have also been on the advisory board of startups such as Atranta and Ambit Design Systems and Calypto and Amper and Versac. And also these days, I serve on the board of directors of a company called Turntide Technologies that is making these very, very interesting sort of energy efficient motors. So in this book, right, in chapter 3, where I talk about innovation in academia, I start the chapter with an interview with Amit Narayan, right? He's the CEO of Autograde, a serial entrepreneur, and he's got his undergrad from IIT Kanpur, PhD from Berkeley, and he started Berkeley Design Automation, and he sold that to Mentor Graphics. He worked for Magna, which was acquired by Synopsys, and they in 2011 started Autograde, right? And in this book, I ask him a series of questions about the mission and vision of Autograde and how they're trying to change the world in terms of distributed energy, generation and consumption, some of the customers that they have, right? Who their competition is, where did that technology come from? As it turns out, it came from Stanford, right? And who the investors are, the Series A, B, C, etc. And sort of discussions about strategic investors and venture investors and whether you should take money from strategics and some of the sort of what the exit strategy is. And we talked about should we go IPO? Will he be bought by a larger company? As it turns out, he kind of talked about the fact that he may be bought by a larger company. And by the time my book was published, that year itself, in 2022, he got sold, right, to Schneider Electric. So a fantastic interview with the leader in this area. So now the question is, we talked about Amit Narayan as a founder, right? So there are these founders that come from three different groups, right? These founders are these people who are the lifeblood, right, of this innovation, and they come oftentimes from academia, as I did, right? I came from Northwestern and started Excelsior, right? But there are lots and lots of other examples of professors who take this technology and found the companies themselves, right? An example is Professor Nick McCon from Stanford, who invented the technology of software-defined networking, right? And then started a company, Nicira Networks, that was bought by VMware. But there are lots and lots of other examples that I refer in my book about other professors who have started companies. The second category is founders, right, who worked in large companies, and they work in the large company and they've invented some new technology or a prototype, and they pitch it to the management that, hey, we should be going in this area. And the large company says, no, that's not related to my business. Therefore, they say, this is not something I'm interested in. At this point, this individual, right, will leave the company and start his own company. An example is John Swanson, right? I mean, he founded Ansys, the company that I am CTO of. 50 years ago, he used to work at Westinghouse Electric Corporation. And he made the observation, hey, if I had this finite element software, right, I could actually solve some very, very interesting problems. Westinghouse was not interested in that business. So he left, he started the company, and Westinghouse was his first customer. And this is a very, very typical example of what happens from founders from large companies. And the third category is the serial entrepreneurs like Amit Narayan that I just introduced in the chapter, right? He started Berkeley Design Automation, he worked in Magma, he started Autograde, right? So an example is Sanjit Biswas and John Beckett, who were graduate students at MIT, left MIT, started Meraki Networks, and they sold it to Cisco. Then they started Samsara Networks, and they just went IPO last year. So these are the types of serial entrepreneurs that VCs love, right? They have the experience of starting companies. Which brings me to how you can actually start companies, right? And if any of you are watching this video, right, and you want to start your own company, right, these are the three criteria that VCs look for, right? Criteria one is, do you have a unique technology, a value proposition, right? A sustainable advantage, right, over other competition, right? do you have, what's the size of the market, right? I mean, how many customers are there? How, I mean, what's the pain point you're solving? How much will they be willing to pay? And through that, you try to estimate the size of the market. The third thing is your team. So three T's: technology, TAM, and teams. Using that, so you build a business plan. So let me double click on each of these areas. The first one is value proposition. So you have identified a pain point, right? A solution, and you said, I'm going to solve this with this unique technology that I've invented, right? So currently there may be many ways of solving it, but you have found this unique way, right? So for example, in Excelchip, right, the company that I founded, right, the technology we solved was a technology to take MATLAB programs and automatically generate register transfer level VHDL, something that would take a couple of engineers, maybe 6 months to do. So the pain point we are solving is we were able to remove the use of these two engineers for 6 months, right? So the value is more than say $100,000. So therefore, if you price it at $50,000, customers would buy it. So that's the value proposition. The second one is the size of the market, right? How big is the market, right? How many customers are there, right? How much will they be willing to pay for it? And so there is different categories of TAM, SAM, and SOM, right? So TAM is the total available market. Assuming that there's no competition, is the potential for sales opportunities in that area for your startup. That's the TAM. The serviceable market is what percentage of TAM can your company's product actually service reliably, right? And the SOM is the share of the market of the SAM that your company will actually be able to serve. So in the case of Excelchip, right, the TAM, the total available market, was the EDA, electronic design automation market, which was about $5 billion. The SAM, the serviceable market in system level design, right, for EDA was about 300 billion. And within that, there were several companies. And we said, well, Excelchip will get maybe 10% of the market share of that SAM, which is about 30 million. So we are going after that 30 million. How do you build a business to get to a 30 million revenue? That is what that sort of business plan is all about. And then the third thing is a team, right? I mean, who are the leadership? Who is the founder? Who is the CEO? Who is the head of business development and sales and so on, right? So, I mean, essentially, it's about how good is the team? Is the team of high quality? Can they work together? Can they pivot to new problems when there are challenges? And there's this insight that I wanted to share with you that VCs, the investors, would love they prioritize the team the highest, right? They would rather fund an A plus team with a B minus business plan than a B minus team with an A plus business plan, because a team will figure out, right? Even though there are challenges, they will see the challenges of the business plan and they will pivot, right? So in the case of Excelti, for example, I mean, I was the founder, right? I was a professor. I had no experience in doing a startup, so there was a negative point. My co-founder was another professor, right? But we brought in some experienced people as VP of engineering, right, and as VP of sales. And then the engineers were actually graduate students. So I would call ourselves sort of a type B, right? We're not an absolutely fantastic team because we are not built startups before. So now the question is, you have a startup, right? You have an idea of a startup, you have a value proposition. How do you actually go to market? How will you sell that product, right? So that is a very important thing, right? So if you're a hardware company, you have to build those hardware things. You have to manufacture it either in the US or in China and so on. You have to think about the supply chain, the different things, and it's very complicated. And what's the gross margin, right? The cost of goods sold and so on. If you're a software product, I mean, obviously you have not a whole lot in terms of cost of goods sold. So those are the things that you would go through, and then you have to figure out, right, will you sell it directly or do you sell it through a channel, right? And so if you have directly, you'll have a salesperson and an application engineer, right? This is what we did in Excelchip, right? This team of these two people will sell $1 million of products, right? So that's that go to market that you have to sort of think through. Now you have to, you're the entrepreneur, you're thinking about a business plan, right? Hey, here's the startup I want to build. You have to write a business plan. What's in a business plan? In the business plan, you have different sections. You have to talk about the company, the origin of the company, right? How the company is organized. You have three founders, four founders. You have taken some kind of a licensing from Northwestern University. Therefore, they also own this. So who are the people who are owning the company, right? You have to say it up front. And then you're saying, what is it that you're trying to sell, right? What's the value proposition of this unique product that you have? And then you say, and the market is this big, right? You have to show your investor this is a really big enough market. And in the case of Excelchip, as I said, the share of the market was 30 million. And you have to show how you'll get to that through that go to market, the sales strategy, which was essentially a direct strategy or a channel strategy. And then you have to define your milestones. You have to say, in year one, I will build this product, I'll have about $1 million in revenue. In year two, I'll build some added features of the product, I'll hire more people, and I have 3 million revenue. Then I'll go to 7 million revenue, then in 12 million revenue, then 30 million. You have to show all these steps, right, in the process. That's how you build a business plan. So now to get to that point, you need money, right? And so there are different types of investors. There are angel investors who are very, very rich individuals who may fund you as an individual. And then there are VCs, there are these large VC firms who sort of raise money from investors and they fund on behalf of those investors into the startups, right? And then there's the large companies, so the HPs and ABBs of the world that I work for, and each of them had an investment arm. So then in this startup, you have to have these different phases, right? The seed stage is you take a little bit of money, maybe a million or two, right? And you are in the pre-commercialization stage where you take this idea and you build a prototype of a hardware or software prototype, right? And then you start sort of shopping that prototype. You're trying to take it to customers, and then you need Series A funding, right, to launch that startup, right? That business idea is tested. This is you think it will sell for $40,000. You find out if it actually sells for 40 or not, or is it worth more, right? And then you raise Series B, which is the ramp up phase. You have justified, yes, your business model is true. It is you have this a product you're building, and the customers are willing to pay 40,000, 50,000, whatever, right? You're ramping up. You need more salespeople, more AEs, right? That's the Series B. You continue to grow your business. You need Series C, Series D funding, and ultimately you grow your company to a very, very large, successful company, and that's when you exit. You sell your company to a larger company, or you go through an IPO process. So I thought I would sort of explain how a business plan is written, right? And it's a very, very simple example. Just and again, taking this sort of the Excel chip tool, the company that I had founded, right? So in a business plan, you're trying to create a plan, right, for your business, right, over a 5 year period. And you say, I'm going to, in my plan, you said, I'm going to build a software product, right? Once you build it, it will sell. The value proposition is will sell the customer each seat for $40,000. So in year one, in your plan, you say, I will be able to sell 10 copies. So 10 times 40,000 is 400,000 in revenue. Now, in your plan, you say, I think I can sell 20 copies in year two, 40 in year three, 350 in year five, right? So 350 times 40 is 14 million. That is your revenue projection from the direct sales force. In addition, you may say, I'll have an indirect sales force through a channel, and the channel will give me only $20,000 per copy. And so 20,000 times the 450 is 13 million. And then I'll charge for yearly support. That's 1,000 copies that I have sold, right? And that times $8,000 is 3.6 million. So you add it up, that's your 30 million. So this is showing your business plan, your revenue growth. Then you have expenses, right? So essentially you have to say, well, to grow to this business, right, I have to hire people for R&D, right? I need me 20 people in R&D in year one, or 40, 50 people in R&D, or I need 20 people in Salesforce. So all that headcount plan, you have to grow, right? So you have an assumption, say, to have 1 million in sales, you need one salesperson, one application engineer, right? To grow to 30 million sales, therefore I need 30 salespeople and 30 application engineers. And you typically need maybe one R&D person per salesperson, right? So you need 30 sales R&D. So there are these models that people build, and using that, you have a headcount plan and your expense plan. That expense is shown here, right? So then you look at a particular year, you have a revenue of 400,000, you have expenses of 1.2 million. Clearly, you're running at a loss of 800,000. Who's going to pay for it? That's where you raise that equity capital. So you have raised 2 million in equity capital Series A. You have a loss of 800K, therefore you have only 1.1 million left in the bank. You raise more funding, right? That Series B funding to grow your business. And now again in second year, you have 1 million revenue, 3 million expenses. You are still running at a loss. And so you end the year with a smaller cash balance. Then you take one more round of funding, say 8, 10 million funding. And by this time, you have essentially grown the business. So your revenue is ahead of your expenses. It is profitable. You have more revenue, less expenses. You have even more profitable. And at this point, you're running your company profitably. So your early investment, the 2, 3, 4 million, is allowing you to build your business and grow your company. This is the business plan, right? You are showing to the investors, right? They're trying to raise money. My plan is to go from 1 million, 2 million, 30 million revenue with expenses like this. And Mr. Investor, I would need your help in getting 2 million Series A, 5 million Series B, 10 million Series C. That is the business plan, right? So then the startup founders sort of go through this sort of challenging process. Oh my God, I'm giving away, I'm raising money, right? I have to give away percentage ownership of the company. And this is my baby, and I'm really struggling with this. And I don't want to give up the ownership of the company, right? But I want to walk you through an example which shows the value of taking the money, right, in exchange for the investment. So let me give you some example, right, and then sort of really come to this conclusion. So in that business plan that I showed you, where this company was trying to raise 2 million Series A, 5 million Series B, 10 million Series C, right? In order to grow to the business, which will be 30 million revenue. In Series A, you're trying to raise 2 million, you have nothing, you have no revenue at that point, right? You're trying to sell the concept. The investor gives you the money, but in exchange for it, they value the company pre-money at say 5 million. So they will take 2/7 ownership of the company. 2 divided by 2 plus 5, right? 2/7 ownership. So in exchange, you will have, suppose you start with 5 million shares, founder shares, and you reserve maybe 2.5 million shares for future employees, right? You will have to give away 3 million shares, right, for Series A. In Series B, you're trying to raise 5 million, and maybe they value the company at say 10 million, right? So they will take a certain percentage ownership, 5 over 5 plus 10. That one third ownership, in exchange you have to give them 5 million shares, right? In Series C, again, you're trying to raise 10 million, right? You have to, and the pre-money value, say maybe 20 million, right? So you're trying to raise 10 million at 20 million pre-money, and they'll get again, say about 4 million shares. So at each stage, you are giving away some equity shares in the company, but but simultaneously, the value of the company is going up, right? So by the time it has grown to a 30 million company, you may be able to sell the company or IPO at a price of say 300 million, at which point you, the founder, right, you started with maybe 50% ownership or 70% ownership. At this point, you only own 25%. We have 25% of a 300 million company. You're making $75 million. This is the incentive that you have, right? And the point I'm trying to make is that if you say, I don't want to give away the ownership, right? Yes, you will have 50% ownership of the company, but 50% of zero is still zero. So this is the struggle that founders go through, and I want you to understand that. The last thing I want to talk about is sort of partnerships, right? And again, as a startup company, you need to form partnership with larger companies, right? And so you start with a technology partnership. You try to identify companies who have much larger sales forces and so on, and you say, hey, I want to be a partner with you, right? For example, Accelki formed a technology partnership with Xilinx, right? The big FPGA vendor. And then you form an OEM partnership where the larger company salesperson actually sells the product on your behalf. And because they have a large sales force, then in exchange for every copy sold, maybe you'll get a royalty of maybe 20%, 30%. That's sort of the established guideline in the industry. And then as you're growing your business, you're trying to raise this funding, right? That 2 million, 5 million, 10 million that you're raising in Series A, B, C, maybe a couple of million will come from that strategic investor. And then ultimately, the company may buy you. So there are these different phases. So this is what I say in my book, right? If you are a startup, right, founder, you have to think strategically about partnerships with large companies so that ultimately you can grow your business. Now, if on the other hand, you're a larger company, right? And this is what this whole book is talking about, right? For a large company to get involved in this disruptive Horizon 3 innovation, they need to scan the industry, right, for different startups, right? So they need to do this, and the starts company can invest in the startup. They can form an OEM partnership with the startup. They can do a technology partnership. And essentially, through that, they bring these newer technologies into the company, right? So I will just give you an example, right? I work for Ansys as CTO, right? And Ansys invested in a company called Dinardo, right? That had this OptiSlang product, which formed a very nice complementary partnership, right, with the our Ansys Mechanical or Fluent software products that we had. And so we started with a technology partnership. Then we did an OEM where we sold the OptiSlang product on behalf of Dinardo, and then we invest in the company and we bought the company. This is the four stages of the partnership that I'm highlighting in the book. I hope you practice it, right? And so in future episodes, I'll talk in detail about how to form these partnerships. So you are a large startup, right, company, and you say, hey, what are the startups that I can partner with? So there are all these different startups that are out in this different startup list. So Crunchbase is a list like www.crunchbase.com. You can look at it, or pitchbook.com, and you can see there are access to have maybe sort of 2 million startups or 3 million startups in different types of technology areas in more than 300 locations around the world, right? So if you're a large company, you have to scan the startup ecosystem and say which of these startups is relevant to my company. And if I were to take that company's product, combine it with my company's product, right? How can I grow the ultimate solution for my customer? That's what I wanted to cover today. Hopefully, this episode was interesting to you. And again, if you want more details, I urge you to buy my book, Innovation Factory. And what I just covered is in chapter 3 of my book, and you can buy the book on both Amazon and Barnes and Noble. And thank you very much for your attention and for subscribing. Please subscribe to my Innovation Factory channel. Thank you for watching this episode.